Today, Graham Stephan released his entire $5 million stock portfolio, and at the same time, Andrei Jikh released basically all of his investments at the age of 32. This was probably not a coincidence, even though Andrei said, yeah, it is, but hey, I'm going to piggyback off of their videos as well, so I think it's a great strategy. There are some really important things that I want you to know about if you're going to be listening to these videos and then applying what's in them. So one really important thing that I disagree with is something that you're going to want to make sure you understand by the end of this video. Now, one thing that I really agree with Andrei is saying that consistency is key. If I had to say what was the key to my portfolio and as an investor, what's going to be the thing that's going to allow you to grow wealth that's going to compound over time, I gotta say it's probably consistency, right? And this isn't consistency with like, are you choosing the same stock every time? This is consistency about your emotions, right? It's consistency about what happens when everyone's panicking in the streets, what happens when there's massive sell-offs, what happens when things go to the moon, what do you do? The more consistent you are with your strategy, the better, okay? Because if you're not consistent, then essentially what you're doing is you're using your emotions, you're using your gut feel, and that's not proven to be something that is good for you to do in the long term to create wealth. So be consistent. Now, one thing to be consistent and build consistent and successful habits is to do something over and over again that's just going to put you in a position where you're more likely to find success. One of those things is to consistently learn and expand your knowledge and your education about finance and about wealth. So it's really simple. Just click subscribe right now. Just do it. Who knows, maybe for the next year, I'm going to be helping you grow your own wealth. So do that. I would really appreciate it. And make sure to like this video because, by the way, I think it does nothing for the algorithm to click like, but what it does do is it actually gets more people to watch it because when they land on the video and they see my weird alien face, they're going to look at those likes and see if it's worth it. And if there's a good amount of likes and a solid like ratio, well, they're probably going to watch it, and that is going to help the algorithm. So let's get into it. Now, Andrei first started his investing years ago, and basically as a dividend investor, meaning he was relying on dividend income, which is pretty cool. Here's my dividend income, right? $40,000 over the next year, around $3,400 a month. So that's great to think, oh, I'm getting money all the time, every month, whether the stock goes up or down, I'm going to get my dividends. Here's the thing. He realized that dividends are not free, right? And dividends are actually not beneficial when you make a big amount of money because you're going to have to pay taxes on that income and you're forced to essentially sell. So don't take it from me. Warren Buffett, who owns more dividend stocks than anyone in the world, explained in his annual letter that he doesn't buy stocks because they're dividend stocks. He buys them because of the value, and that happens to correlate with companies that give dividends. So make sure to watch my video on dividends and how I would actually rather not make dividends. So I'm reinvesting this money anyway. The only difference is that I now have to pay taxes on the dividend money. So Andrei Jikh's portfolio is mostly on Robinhood to start, and he has the exact same start as I do, which is why I actually wrote to him that we kind of started on the same path. So that was kind of cool to see his likes there. But we started on Robinhood as the first app. Maybe some of you guys have it. And by the way, I'm going to talk about why you should not be buying one sort of asset on Robinhood. But here is my Robinhood account. These are individual stocks. So I've got my Tesla, I've got my Apple, and I've got just the companies that I kind of just believe in and have believed in since I started investing. So Tesla and Apple are my go-tos. Bank of America I bought randomly because some guy who I followed bought Tesla and he put $1 million in Tesla and it quadrupled. This is like quadrupling to like $40 per share. So hopefully he still has his shares. And he was like, Bank of America is undervalued. This is something I don't recommend you do, is just listen to some YouTuber like me to buy a stock or to listen to someone. But I decided to just buy some shares, not a lot, $1,000 worth. I also have some IAU, which is some gold, and I have just randomly less than 1 share of Amazon because I just clicked it. I also have a Bitcoin, about 1/3 of a Bitcoin. So this is what I do not recommend you do. I do not recommend you buy crypto on Robinhood. I actually learned this from Andrei Jikh too late, but I cannot transfer these this Bitcoin. Instead, I have to sell it and then take the money out. I can't transfer it. It's not like a wallet. All right, so that is something. But here we're talking about individual stocks. Now, Andrei talks about high conviction stocks, and he actually talks about something interesting. So Andrei actually talks about how people who are rich, often the way they got there was by having high conviction, meaning that they really believed in something and they put a good amount of funds towards it. Not that they were super diversified and they spread all of their money out. Now, this is a risky way to look at things, right? To think, oh, you know what? To be rich, I got to be high conviction and invest a ton in one area. But the thing is he's not wrong. In the book 0 to 1 by Peter Thiel, who is part of the PayPal mafia with Elon Musk, Peter talks about taking risks that are high conviction, meaning you have high levels of confidence in them, but those are things that will not put you out of the game. Okay, so they're not risky enough where you can go to zero and you're screwed, right? That is something that I believe in and that can allow you to grow massively. This portfolio here of $243,000, this was grown mostly from around $18,000. I can show you right here. This is my Tesla market value of $198,000. Guess how much I put into Tesla at the time? The cost was $18,000. So this was high conviction for me at the time, years and years ago, when I wasn't really investing super much. I've been investing for 10 years, but I never bought like $18,000 worth of a stock at this point. And so I had high conviction, but at the same time, it wasn't going to wreck my bank account. So here is the cost and the market value. So we added around $180,000 of return. And this was with putting high conviction, but not getting super risky with things. And I'm still able to have some pretty massive gains. So high conviction, the rule is you can go for high conviction if you really believe in a company, as long as it doesn't take you out of the game. The other individual companies that I have are in my Charles Schwab account. This is where I do most of my trading and investing now. It is the reason why I use it is it helps me automate some of the processes. I'll talk about that in a second. But I moved from Robinhood to Schwab, and now I do pretty much everything on Schwab. In Graham Stephan's video, he actually talks about his individual stocks, which is kind of weird for Graham because he's so about ETFs and index funds. But he talks about some of his individual companies. And one of those is, of course, Tesla, which we all friggin' like. And the reason why he started Tesla is because he got in a Tesla. He bought his Tesla and he started realizing the potential of the product and how amazing it was. This is the same realization I had when I first got into a Tesla for a test drive. That's when I bought my $18,000 worth of stock on Robinhood. This was years ago, by the way, and this was really flat for years. It didn't move until all of a sudden the market realized its potential. But also, Graham believes in another product he uses, which is the Cheesecake Factory, which I think is pretty funny. But it's because he uses the actual product, and he actually likes the Cheesecake Factory because of the large portions, of course, with Graham. And he buys products he knows. So that's the same with me, right? I guess what? I'm recording this actually on my Mac, which I'm also recording it on my phone. I'm also have my Apple Watch charging over there. I'm in the Apple ecosystem. I understand the market, I understand the competitors, and I understand how much of a brand Apple has and how hard it would be for me, for example, to switch over to Android. And I think, switching from Android to an Apple device is also pretty hard. But the ecosystem is really, really powerful with Apple. I love that they make the software and the hardware, and it's a company I use day to day. Amazon, same thing. An amazing ecosystem as well. The companies that are going to be worth a ton are companies that have an ecosystem that is a full cycle and a full circle. So, for example, on Amazon, I'm buying products. Guess where I'm buying them? On Amazon, but guess the only other place I'm going to is grocery stores. Amazon is getting into the grocery store market. How about entertainment? Well, I'm streaming Mad Men currently on Amazon Prime. The more an ecosystem can be created, the more valuable a company can be. Tesla is very unique in that there's no dealership, right? They absorbed that value. They absorbed the batteries. They're actually starting to make them themselves. How about gasoline, which is a huge industry, right? Well, Tesla is actually absorbing the energy system for their cars as well with the superchargers, right? So they're actually taking a lot more value than a traditional car company because they're actually the software, they're actually the hardware, they're actually the charging, and there's a lot more to come. Berkshire Hathaway is basically my play against tech because I have a lot of tech. All my companies that I buy are pretty much growth companies, right? They're companies that I believe have huge potential in 5 to 10 years. I don't plan on selling within 5 to 10 years, and that's how I come into buying products and stocks. But with Berkshire, it's basically the opposite. It's, hey, what companies have high value, and I bought during the dip, and so we were able to have some pretty good gains from buying during the market dip of the pandemic. So that was pretty cool to just buy some of that. And here's the cost basis, right? 104,000 of Tesla, 69,000 of Apple, 23,000 of Amazon, and 18,000 of Berkshire. So that is the percentages here. Also, you have to understand that these change over time. So because I had I actually had Tesla at around 1,600% in the gain, but I just kept adding more as things dipped this last month. So I added onto my positions and bought in around $580 to $640. And so the gain loss percentage lowers because I have more of money into it, which averages out the actual gain per share. All right, so those are my individual companies, but here's the thing. I'm similar as Graham Stephan, I'm similar as Andrei Jikh, and if you pay attention to the market, you're going to probably end up realizing that, yeah, you probably should have a good amount in ETFs as well, in exchange-traded funds that work exactly like a stock where you can buy and sell from a stock ticker like VOO, which is the Vanguard S&P 500. So this is what I own. Now, this is not actually the only ETF that I own, and this is not an ETF I own in my retirement account. Make sure to subscribe if you want to watch the next video I make on the retirement account allocation. I'm not going to count that towards this overall portfolio reveal, and I don't buy this with the retirement account, and I'll explain to you why in that video, so subscribe if you want to see that. So this is a fund that I have a good amount of funds in. In fact, I have around 1 million, when the numbers get confusing, that's when you know you're doing good. So $1,411,000 in this one ETF. So I actually broke this down as a kind of favor to myself to understand, like, what do I have in this ETF? So this ETF basically owns the S&P 500. You can see its growth here over time, and it owns the S&P 500 essentially by buying the actual companies in a market cap weighted way. So it owns mostly Apple, and then Microsoft, and then Amazon. 28% of the net assets are in the top 10 holdings. So what I did is I broke this down so I can get an idea of, wait, how much Johnson & Johnson do I own? How much JP Morgan or Visa or Facebook or Google, which is Alphabet, do I own? Because to me, I don't even think about owning Google, but I do. All right, so ignore the Schwab thing right here, but here is the value in ETF. So Apple, we actually have 6% from the ETF. So out of the 1.4 million, that means I own an extra 84K in Apple. How about Microsoft? That's 76,000 in Microsoft. Amazon, another 57,000 in Amazon. So Facebook, 26,000, Google, 26,000. These are different classes of Google stock. Tesla, another 22,000 because it is 1.59% of the S&P 500 VOO ETF. And Berkshire Hathaway, another 20K, JP Morgan, 19, 18. So we own Disney also at 14,000. And I don't even think about owning Disney or Nvidia, right? So that is what an ETF does. And when we add them up, we can actually see the value, because I did a little bit of work here, it took me a while, of what happens when we add up the actual fund. So Apple, we have $218,000. Tesla, we have $620,000. Amazon, we have $91,000. And the next biggest would be Berkshire here at $46,000. And Microsoft here, it has such a high percentage because the market cap is so high that it's one of our top holdings without me even thinking about it. So those are some of my top holdings in the actual stocks with the ETF combined. Now there are some other kind of strange, quirky things that I do own, and it's not exactly something that, I would say I did a good job in investing in. One is gold. I have IAU, which is a holding of gold that basically tracks gold. And so IAU is my gold holding, which we actually have $65,000 worth of gold, which is kind of crazy. This was during the market sell-off right when the pandemic hit. I bought a bunch of gold and I thought, you know what, screw it. I don't know how bad this can get. I've been through the recession, the Great Recession, but I don't know. Maybe things can get significantly worse than that. The next holding is BLV. This is a bond ETF, like a long-term bond ETF. I don't know why I bought this. ARCG, Genomics, ARC's fund, have $8,000 in that just because I wanted to learn more about it. I did a little bit of studying. I purchased a bit as a way to kind of trick myself into learning more. I haven't added to that position because my conviction hasn't increased. I also have an intelligent portfolio. Now, this is something that I think is really cool. This is the intelligent portfolio right here. I have $208,000 in this. This is something that I think everyone should have just because it makes things super easy to keep track of. Now, the other thing that this does is it automates your investing and it can automate your tax loss harvesting so you owe less in taxes. If you want to watch that, click on my video above here. I'm going to leave a little card there on how this automatically saves me thousands in taxes. This is something I do not think about. This is something that automatically every month 10K comes out of my account and it gets put into this allocation of stocks. And there's a whole percentage here, but I filled out the answers to some questions it gives you to try to get like the highest stock allocation, because based on your risks, based on the time you want to take out your funds, it'll change the allocations, try to create a portfolio that's great for you. It automatically reinvests dividends. It automatically rebalances, and it owns a bunch of different ETFs. So we're counting this as our ETFs because it does, right? So large company stocks is holding these ETFs, and it holds international, small cap stocks, REITs. So it is all over the place, but it creates a really diverse portfolio that I don't even think about. It invests it automatically, and it's grown, and it's really cool to just sit back and watch this thing grow. In Andrei Jikh's video, he also talks about his cash allocation, which is pretty shocking. He has 1.4 million in cash. I don't have that much in cash. Right now, around $601,000 in cash. And he says in his video, hey, I should have 95% of my money invested, but I'm keeping money away for taxes and for potential buys. So that potential buy thing is a little bit of a timing the market, and also this is something that even Warren Buffett has left a lot of cash on the sidelines to time the market, but it's very, very hard to do. So I'm trying to add as much into my ETFs as possible, or if there's a dip in the market, I'll buy things that I really believe in, like Apple, Tesla, Amazon. So here is the amount that I have, and this is an amount that I'm trying to get into the market by dollar cost averaging. Every Monday, I'm investing in the market. I don't want to talk about real estate yet. I did buy a house. I want to show that in a whole other video, how I got the best rate, how I think it's going to appreciate, and kind of some hacks to make the most money out of that kind of investment. I also want to leave my crypto to another video because I am on a few different platforms and I really want to make a dedicated video on that. So how do you build a portfolio that builds wealth that maybe is even generational, or it's something that can allow you to compound over time? If I had to leave you with anything, it's probably this: hustle to make money, live below your means, don't let the lifestyle creep happen. This is where you increase your lifestyle as you make more money. It's better to act broke and try to live below your means, taking as much as you can to save it and invest it rather than spend it on nonsense that you don't need. Automate the process so you don't even have to think about it. The Robo-Advisor by Schwab is pretty amazing at that. Automatically, you can put $500 into the robo investing platform that takes it out of your bank account every month. You don't think about it. This is what I've set up for friends and family that are maybe more emotional, that don't have the ability to buy in consistently because they're going to let their emotions get in the way. The last thing I would say here is create a strategy and stay consistent. Decide what your allocation is going to be and stay consistent. Compounding is magic. You have to let it work. I was recently asked about my overall allocation, stocks compared to ETFs, and I did all this math to be able to get to it. And what it was is I have 65% in ETFs, 35% in individual stocks. So as you want to play the market and leverage your knowledge and your know-how to buy stocks, still realize that you probably, not recommendation because I can only give you opinions and education because I'm not a financial advisor, but what I do is I do that and have high conviction, but I do not invest the majority in those. I still will be strong on the ETFs, which happen to be the same companies that I believe in a lot, right? The tech companies like Apple has the highest market cap, so it's the highest percentage on the ETF, right? Or Tesla or Amazon, which are up there. So that's it for this video. Thanks so much for watching. Thanks for hanging out. Stay consistent, my friends. Subscribe, like this video so you don't miss out on the next ones. This is AI, and I'll catch you later.